Welcome to appropriation accounts for partnerships. An appropriation account is really the distribution or shows the distribution of profits from the income statement, the last figure that's in our income statement, or what we might call the statement of profit and loss. So the final figure from there is where we are going to start, and we're going to show how that profit might be distributed to the partners because of capital, drawings, salaries and sharing profits. Now it does show how a reward can be given out or distributed to partners if the partners have earned a reward such as a salary or interest on capital or profits. Conversely, any charge to the partners will be added onto profits, and obviously a reward will be paid out of profits to the partners. Items that are here will also be accounted for in the individual partners' individual current accounts. So anything that's going to partner A here in the appropriation account will also show up in A's current account. Any reward to be paid to B or charge that's incurred to B will be accounted for here and also in B's current account. This is assumed to be done for 1 full year. Most of these figures, like the 10% interest on capital, 5% interest on drawings, is per annum, which means yearly. So we're assuming this is for a year. And now that's because the terms and conditions stay the same for the partnership for the whole year. Now if the terms and conditions change within the year, let's say after month 4, then we would do 2 appropriation accounts, one for the first 4 months with the original terms and conditions and one for the remaining 8 months with the new terms and conditions. And so that would be called a split year scenario. So we're just going to have a quick look at how this is done. So the first thing we do, we start with the profit figure from the income statement or statement of profit and loss, and this is our appropriation account that follows after that figure, and we do a vertical format downwards. Okay, so the first thing we need to do is account for interest on drawings. Interest on drawings is a charge to the partners for taking money out before they should. Now, we're assuming all of these things, these drawings are taken out at the very beginning of the year, and therefore the situation is the same for the whole year, the 12 months. Now, it may well be that drawings are taken out not at the beginning and possibly after 2 months or 7 months, and therefore we would need to do an apportionment then for the months that there's more drawings or less drawings. But in this case we're assuming that these figures are for an entire year. Okay, so let's make a start. So we have interest on drawings first. Interest on drawings is agreed in the partnership agreement to be 5% per annum per year. A's drawings, A has taken out 20,000 from the business at the beginning of the year, so for an entire year, for 12 months, they've taken that out 12 months before the year end, which means at the beginning of the year. So 5% is going to be charged on that. So 5% of 20,000 is 1,000. So A's interest on drawings is 1,000. We're charging A 1,000 because they are taking out money before the business really wants them to. And then B's has taken out drawings of 40,000 at the beginning of the year. The charge on that is 5% per annum, 5% a year. 5% of 40,000 is 2,000. Okay, so now we've got the total figures for each partner. We can total it up here. That gives us 3,000. Now, this is going to be added on. We need to add interest on drawings to the profit that's already there, because interest on drawings is a charge to the partners and adds onto profits. So we're going to add that on. This now we are running downwards vertically in the appropriation account underneath the profit figure. So we've got 182,000. The total interest on drawings is 3,000, and therefore we're going to add that on. That gives us a running total of 185,000. Okay, the next thing is salary. We can see here that the partnership has agreed 0 salary for A. Maybe A doesn't come in and do any hours within the business, but A is just there as an owner. But B comes in and works within the business for a few hours and therefore is entitled to a salary. So that is per annum. So we are going to put 0 in for A and 10,000 in for B. The total salary we put over on the right hand column is 10,000. And that's going to be, we're going to minus that. We minus salary from profits because the business is going to distribute out profits to pay out for any reward the partners have earned, including salary. So that's a minus 10,000 from the current running total of 185, which means we now have a running total underneath of 175,000. Okay, next thing we do is interest on capital, and we also minus interest on capital, because capital is money that the partners have put into the business to try and help the business grow and work with, some working capital, and therefore the partners are entitled to a reward, as in this case decided as 10% on that capital figure. So if we do 10% of 100,000 for partner A, that is 10,000. And 10% on 150,000 for partner B is 15,000, so that is the reward that each partner will get. Now, as a total, that is 25,000. We put that over in the total column, and that's going to be minused out of the running total, which is 175. We minus 25,000, so we are running down this column. And then if we take 175,000 minus 25,000, we now have a current running total or residual profit, remaining profit after this distribution of 150,000. The last thing we do is profit share. Profit share in this case has been agreed as equal profit share, 50-50. It could be different, it could be 25%, 75%, it could be any proportion. So in this case it's 50% for A, 50% for B, so 50% of 150,000 is 75,000 for A, 75,000 for B. Now when we add all that up, these two, it comes to 150,000. And since this is going to be distributed out of the residual profit, we're going to minus, again we're going to run down this column, we have a current running total of 150,000. We're going to minus 150,000 to pay out for the profits that the partners are entitled to, and that would mean that we are then left with zero. So therefore we have successfully distributed or appropriated those profits to the partners. And so that's the full thing. Now you can see the first thing we deal with in an appropriation account is interest on drawings. That starts with an I. The second thing we do is minus salary. That starts with an S. Interest on capital I, profit share P. So you can summarize this to try and remember it as ISIP. ISIP, interest on drawings, salary, interest on capital, and then profit share. So hopefully that's a quick look and helpful way of looking at appropriation accounts for partnerships.